On the night of February 28, 2026, traditional markets were closed. The U.S. and Israel launched strikes on Iran. Crypto was the only liquid market in the world. 472 million XRP, worth approximately $652 million at the time, flooded into Binance in a single wave. Whales rushed for the exit through the only door open on a Saturday night. XRP dropped from $1.43 to $1.27 within hours. Now here is what that number actually tells you. Not about panic, but about positioning. Because the same wallets that sent 472 million XRP to Binance in one night have been buying it back quietly ever since. CryptoQuant data from April 6th shows whale accumulation at a 10-month high. Large wallets adding over 11 million XRP per day on a 30-day average. The exit door became the entry door, and the whales didn't announce it. Here is why this accumulation pattern is significant right now. Not in 6 months, not in theory, but today. The single variable that has been suppressing XRP's price. In 2026 is not regulatory uncertainty. It's not the banking lobby. It's not market structure. It is oil, specifically the Strait of Hormuz. Since the U.S. Iran war began on February 28th, Bitcoin has traded with an 85% correlation to the Nasdaq during oil spike events. XRP has amplified that move, dropping harder on escalation and bouncing faster on de-escalation. The Strait of Hormuz handles approximately 20% of the world's daily oil supply. When it closes, oil goes above $100, inflation expectations rise, the Fed can't cut rates, and institutional money leaves risk assets. But here is what that dynamic actually means for an XRP holder who understands the structure. The bullish catalysts have not been canceled. They've been paused. And the geopolitical variable that paused them is now in active de-escalation for the first time since February. So here's the question that should be sitting with you. If whale accumulation is at a 10-month high, the Strait of Hormuz is showing its first real peace signals. Oil has pulled back from above $100 to $95, down 19% from its peak. And the FOMC meeting is happening today and tomorrow, with a dramatically weaker inflation case than last month. What does the price of XRP look like the week after the Hormuz macro overhang lifts? We're going to build that answer with data. But first, the oil-crypto correlation. Because understanding the specific mechanism is what separates a reaction from a position. This is XRP news flow signals. We track the macro variables, the on-chain data, the geopolitical signals, and the institutional mechanics, and we map them to XRP's price structure without the noise layer. Let's get into it. Let's build the oil-crypto XRP chain precisely, because understanding it is the difference between reading every news headline as noise and reading it as a signal. The Strait of Hormuz normally carries roughly 20 million barrels of oil per day, approximately 20% of global supply. Since the Iran war started on February 28, tanker traffic through the strait has dropped over 90%. The IEA deployed 400 million barrels from emergency reserves on March 11th, the largest release in its 52-year history, just to buy time. IEA head Fatih Birol was direct. In April, there is nothing, calling it worse than the 1973 oil embargo. When oil stays above $100, inflation expectations rise. The Fed cannot cut rates, or has to raise them. Institutional desks reduce risk exposure. Bitcoin drops. XRP amplifies the drop. The correlation is documented. During the March 19th sell-off, Bitcoin showed an 89% correlation with the S&P 500 and 95% with gold. Everything sold at the same time, same trigger. XRP's drawdowns have consistently exceeded Bitcoin's percentage moves during oil spike events throughout 2026. The signal to watch for Hormuz resolution is not the news headline. It is the ship insurance premium for Strait of Hormuz transits. Before the war, less than 1% of ship value. At peak conflict, 7.5%. When those premiums fall below 2%, the strait is genuinely safer. That number is more reliable than any diplomatic statement. As of this week, Iran has reportedly proposed a new peace deal. Oil has pulled back to $95, down 19% from its peak. Bitcoin is back above $77,000. XRP is recovering toward $1.40. The March CPI core reading came in at just 2.6%, below economist expectations, because the energy-driven inflation spike was already fading before oil fully peaked. The FOMC meets today and tomorrow. For the first time in weeks, Fed Chair Powell walks into that meeting with an $85 to $95 oil price, instead of the 100-plus environment that made rate cuts impossible. But the oil macro story is only half of the picture. The more important question is what XRP's price structure looks like once that overhang lifts. Specifically, what the on-chain accumulation data tells us about who is going to be holding when that moment arrives. That's next. Let's be precise about what CryptoQuant's April 6th data shows. Whale accumulation, defined as large wallets adding more than 1 million XRP, reached a 10-month high. These wallets have been adding over 11 million XRP per day on a 30-day average basis. Exchange reserves have fallen to approximately 2.6 billion tokens, the lowest level since 2018. XRP exchange outflows have accelerated alongside that accumulation, meaning less XRP is sitting on exchanges available to sell. XRP has posted 6 consecutive monthly losses, the first time since 2014. The token is down over 60% from its $3.65 cycle high last July. And throughout that entire decline, through the October liquidation event, where $19 billion in positions were wiped in under 24 hours, through the Iran war shock, through 6 straight red monthly candles, the wallets that matter have been adding. Here is what the historical pattern on XRP's weekly RSI tells us. The current RSI structure is similar to patterns observed before XRP's 2 previous major cycle recoveries. The $1.30 level is held as a close on every significant test, not held momentarily, held as a weekly and monthly close. The accumulation at these price levels is not retail FOMO buying dips. It is large wallets with long time horizons building positions while the macro suppressor is active, because they know what the price looks like when it lifts. Now, before you read that as a simple signal to buy, there's a layer underneath the accumulation data that most coverage completely ignores. And it's the layer that explains not just whether XRP goes up, but how it goes up. The utility game theory model. That's next. Marcus Infanger, Ripple's VP of RippleX, the developer division, has been specific about a distinction that most retail XRP analysis collapses. The gap between the current price and what XRP is worth based on utility demand is not a market inefficiency. It is a timing gap. He described it as the price-demand gap, a temporary state where utility is expanding quietly, while the price reflects neither the current utility level nor the future utility scale. Digital asset analyst James Check, known as Checkmate, published what has been called the utility bathtub model for XRP's price trajectory. Phase 1, the floor builds. Real usage on the XRPL creates steady, non-speculative demand. Every ODL transaction, every tokenized asset settlement, every RLUSD transfer creates mechanical demand for the ledger. This lifts the price floor gradually, not dramatically. This is the current phase. Phase 2, the compression breaks. Exchange supply compresses. As institutional ETFs lock tokens in custody, whale wallets accumulate off exchange, and ODL activation increases transactional demand simultaneously. When institutional capital that has been waiting for regulatory clarity finally deploys into spot, the floor rises rapidly. Phase 3, speculative amplification. Once the move begins, Retail FOMO and momentum traders add volatility on top of the structural move. The price overshoots utility value before mean reverting to a higher floor. This three-phase model explains why XRP can be simultaneously right on the utility thesis, early on the price timing, and frustrating because the floor-building phase feels indistinguishable from sideways decay until phase 2 begins. The accumulation data suggests we are late in phase 1. The regulatory calendar suggests phase 2 is weeks away. The macro overhang, Hormuz, is the one variable that has kept phase 2 from triggering despite everything else being in position. And that brings us to the part most channels won't calculate, because it requires being specific about what the Clarity Act passage actually does to XRP's price. In each of the three-phase model scenarios, and the range is wider than most people expect. That's next. Let's build the Clarity Act price framework the way institutional desks build it. Conservative, moderate, and bullish, with the specific mechanics behind each. Scenario 1. Conservative. Clarity Act passes, Hormuz resolves. The regulatory overhang on XRP spot disappears. The compliance barrier that has kept bank partners and stablecoin settlement, rather than ODL, drops significantly. ETF inflows resume toward JP Morgan's $5 billion year 1 target. Price range, $1.50 to $6, near-term post-passage. Timing, H2 2026 if the bill passes by June. This is the scenario where XRP breaks its 6-month losing streak and begins a sustained recovery. Gradual, utility-driven, consistent with the bathtub floor building model. Scenario 2. Moderate. Clarity Act passes, Hormuz resolves, Fed cuts. If oil stays below $90 and the FOMC signals a more accommodative path, even one cut before year-end, institutional risk appetite returns broadly. Crypto captures a disproportionate share of rotated capital. XRP ETF AUM reaches $5 billion in custody. ODL activation accelerates in Korean, European, and UAE corridors. Price range, $2.50 to $12 within 12 months of passage. This is the scenario where the three-wave model begins. JP Morgan, Goldman Sachs, and Tier 1 institutions in Wave 1, followed by mid-tier banks and sovereign wealth in Wave 2. Scenario 3. Bullish. All of the above plus scarcity trigger. Exchange reserves compress below 1.5 billion tokens. Institutional demand from ETF custody, ODL transactional use, and tokenized asset settlement all activate simultaneously. BlackRock files for a spot XRP ETF. The supply math produces nonlinear price response. Price range, $4 to $25, the upper end of analyst consensus, with specific price discovery dependent on institutional inflow timing. This is the scenario where XRP's 6-month losing streak looks, in retrospect, like the longest accumulation window it has ever offered. The variable that separates Scenario 1 from Scenario 3 is not the Clarity Act. That is a shared trigger. It is the speed of ODL activation across Ripple's 2026 bank partnerships. If you're tracking this framework week to week, the oil data, the accumulation numbers, the regulatory calendar, subscribe to XRP News Flow Signals. This is what we build every single week. Data, no hype. The button is there. Let's close with the specific data points that matter between now and the end of this week. Today and tomorrow, April 28th and 29th, the Federal Open Market Committee meets for the first time, with Kevin Warsh confirmed or near confirmed as the incoming Fed chair. The key data point? Oil is at $95. Core CPI for March came in at 2.6%, below expectations. The energy-driven March inflation spike is showing signs of fading. If Powell's forward guidance on Wednesday softens, even marginally, even a single phrase about the Fed's willingness to act as conditions evolve, it will be read as the beginning of a dovish pivot. Bitcoin will react. XRP will amplify. The ship insurance premium for Hormuz transits is a signal to watch more than any press conference. Below 2% means the strait is genuinely safer. When that drops, oil follows. When oil drops, the Fed has room. When the Fed has room, institutional money flows back into risk. And when institutional money flows into risk, in the current supply and regulatory environment, XRP is not the same asset it was in the previous cycle. It is an asset with commodity classification from the SEC and CFTC, $1.53 billion in ETF AUM and growing, 2.6 billion tokens on exchanges, the lowest since 2018, whale accumulation at a 10-month high, the Clarity Act markup with a May to June target, K-Bank, Deutsche Bank, Kyobo Life, and Convera already integrated on Ripple. The SEC chair calling T+0 settlement the most exciting thing in finance. Every structural element is in place. The only active suppressor is oil above $90 and Hormuz uncertainty. That suppressor is weakening. Here is where everything lands as of April 28, 2026. On February 28th, 472 million XRP left Binance in a single night as the Iran war began. That was the maximum fear event. XRP dropped to $1.27. Since then, across 6 consecutive losing months, through the largest IEA emergency reserve release in history, through Trump's obliteration ultimatum on March 22nd, through oil above $100, the $1.30 level has held. Every single monthly and weekly close. And throughout that entire period, large wallets have been adding over 11 million XRP per day. The whales who sold in panic on February 28th did not stay out. They came back in, quietly, consistently at lower prices. And they have been building positions that retail investors don't see because exchange outflows look like selling when they're actually long-term custody. The macro suppressor, Hormuz, is de-escalating. Oil is at $95. Peace talks are progressing. The Fed meets today with a fundamentally different inflation picture. The regulatory timeline is the tightest it has ever been. Clarity Act markup by May 21st. Senate vote by June per Senator Lummis. SEC innovation exemption within weeks per Atkins. Warsh confirmed this week. And XRP's exchange supply is at a 7-year low. The 472 million XRP that left in a single panic night has been methodically replaced by accumulation from wallets that understand what comes next. The suppressor is lifting. The accumulation is real. The regulatory window is open. What happens when all three converge is not a prediction. It is a mechanical consequence of supply compression meeting institutional demand activation, exactly as it is played out in every institutional asset adoption cycle in modern financial history. This is XRP News Flow Signals. Data, not hype. Every time.